Good afternoon and welcome to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Jason Benowitz, who's a Senior Portfolio Manager over at Roosevelt Investments. And the question that we're asking is, should long-term investors be worried about the volatility that we're seeing in the markets in 2018? Jason, thank you so much for joining us back again at MarketSite. And that really is the question, because 2018 certainly looks different in terms of market composure relative to 2017. So what's your general outlook, and do you think longer-term investors should be concerned with market volatility?
Thanks, Jill. And you are absolutely right to point out that volatility has picked up in 2018 relative to 2017. But when we look at the market with our longer-term lens, we still think that the fundamentals that are underpinning the late cycle bull market are intact. So these would include synchronized global growth, which we continue to see across the major economies, easy financial conditions, and strong corporate earnings. Now, so far this year, investors may have been thinking that growth would actually accelerate in the United States in 2018, and we haven't seen that, so there's been some disappointment. Some of that could be attributable to weather, some to seasonality, and some to concerns about trade. And this has injected volatility into the markets, and it's also reduced the overall stock market valuation. So as we look from here through the end of the year, we think that companies in the S&P 500 could perhaps earn $160 this year, $175 in 2019. If we use a 16 times multiple, that gets you to 2,800 on the S&P 500 by year end. That would be close to a 10% total return over the next 9 months. We think that's attractive, and our clients should stay invested.
So the technology sector, that was a significant catalyst for strength in equities last year, and even to a certain extent a little bit this year, but they have been under pressure along with the broader market as of late. Do you think tech is going to take a pause here?
So we have seen technology stocks underperform over the last month, and we think this is attributable to regulatory risk, both in the United States and in Europe, and we think that this really represents a buying opportunity for the sector. When we think about technology, we begin first with at Roosevelt that we're thematic investors, and we really think the mobile world, or the proliferation of smartphones and what it means for the economy, is really sort of the key theme across this broader market cycle. And the largest technology stocks in the index are really the ones that benefit the most from this theme. And we don't think that regulation is going to derail that train. So if you take Facebook, for example, it's at the center of the storm. And yes, it's true that the company was irresponsible in sharing its user data, and it should have policed its own ecosystem better to deal with bad actors. But we think the company can fix these issues without impairing its long-term earnings power. And when you think about Facebook, it's growing its earnings at a 20% clip. It has a very high return on capital, and right now it's trading right at the market multiple. We don't think that makes sense. The stock is a buy, plain and simple.
All right, so earnings expectations are quite high for the first quarter. We're going to kick that off this week. What will you be looking for, and do you think guidance and commentary around macro markets is what's really going to move headlines and how stocks react?
Yeah, so we think that companies broadly will do well in the earnings season over the next 3 weeks. Coming into the season, we look today relative to a year ago, we see that the U.S. dollar is weaker, we see interest rates are higher, we see oil prices are higher. So this should be tailwinds for the companies that are multinationals, banks, and oil companies. So we see all of that as supportive. On the other side of the ledger, the weather hasn't been great in the first couple of months, and that could weigh in on retailer results. And also, when you look at the manufacturing purchasing manager indices outside of the United States, those have weakened a bit, and so the global industrial companies, it could weigh on their outlook. But as we sort of put all that together, we note that the valuation has re-rated lower over the last few months. And so in that sense, the bar, we think, is lower for companies. And so we expect more often than not companies to exceed expectations and stocks potentially to move higher on the earnings reports. We think that this earnings season will sort of demonstrate to investors that if they're concerned day to day about sort of the geopolitical or trade risk headlines, but in fact, in the background, companies can really grow earnings at a pretty fast clip, and we think that ought to reassure people.
All right, and to wrap up, let's talk about the financials, because they're the ones that are going to kick it off on Friday morning. And how do you think they're going to perform? Rising interest rates, deregulation should be helping those stocks, even though the financial sector is in line with the S&P a little bit down on the year. What will you be looking for specific to financials?
Sure. So in addition to the factors that you mentioned, we also look at loan growth. And here we see something very promising where the Fed releases data weekly, and in aggregate, loan growth, which had been decelerating over the past several quarters, actually began to accelerate at the end of the first quarter and into the second. So we think that's very promising. The deregulation news has actually picked up in 2018 across many of the different agencies, whether it's Treasury or the Fed. And so we think commentary on the earnings calls relative to that topic will be important. Really the key risk in terms of the bank's reporting will be when you look at the yield curve, it's actually flattened over the last several months. And so that may weigh in on their net interest margin forecasts. But all in, as you mentioned, the stocks, they really only performed in line with the market. And we think since things are on balance positive, that they are perhaps set up well to move higher on earnings.
All right. Well, thank you very much for joining us at MarketSite. And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.